Hello everyone, my name is Michael Lamott and I am the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. The stock market is one of the best opportunities out there, and it's accessible to all of us, and in order to achieve financial freedom, I truly believe that it's imperative for us to learn how to take advantage of it. It's something that's doable. We can all do it. It's just a matter of putting in the time and the effort and the hard work necessary in order to be successful. And so in order to help you do that, we created this new series of how and when to sell your stocks. And in this first video, we're going to talk about things to look for when setting your initial stop loss. So whenever we buy any stock, it's very important to understand where we're going to get out if we're wrong. So often, when we buy a stock, we're only thinking of the upside potential because we did the homework, and this is a stock that's going to go up 100, 200, 500% or more, or so we hope, right? And so it's great to think about those kind of things and all the potential, but it's also very important to make sure that when things don't go right, when they don't go in our favor, that we're able to cut our losses and cut our losses very quickly, because if we don't, they can get bigger and bigger and bigger, and before we know it, we're in a very deep hole that is very difficult to climb out of. The way to win in the stock market is by being able to stay in the game a long time, and the way that we do that is by cutting our losses short and allowing the wins that we do have to continue to compound. The only way to really compound is by not giving up too much ground when we do have a loss. And so that's why we want to have stop losses, and we want to plan them well in advance, even before we put the trade on, so that way we're not doubting ourselves, that we're not giving it that little bit of extra room. It's just something that's automatic. It's sitting there, and if the stock crosses below X, that's it. We're done, and we're moving on to the next trade. There are three main things that I look at when I go to set my stop losses. The first thing that I do is I try to identify a support level. I look at long-term support levels, intermediate term, and short-term support levels. The next thing that I look at is the behavior that the stock has around key moving averages. I'll look at the 10-day moving average, that's the shortest term one, the 21-day exponential moving average, the 50-day simple moving average, even the 100 or the 200 simple moving average, although I'm using those less frequently because more often than not, the stocks that I'm looking at are high momentum growth stocks, and they're just not pulling into those levels. Although they can, and when they bounce, that's often a good spot to enter. But we'll get into all that. And the third thing that I consider is the distance of wherever the stop is going to be from my entry point. If the stock is, say, 15-20% from a good support level, that's just too far away, in my opinion. Most of the stocks that I'm entering or taking entries on have a stop loss that's on average about 4 or 5%. And the reason why I limit myself to those kind of trades, that every so often I'll have a stop that's 8 or even 10% away as an absolute max. Like, that's my cap, the 10%. But the reason why I'm capping myself and trying to go for the smaller percentages for a stop loss is because when I'm looking for a trade, I'm looking to make at least 3 times the amount that I've risked, right? So if I risk $1, I'm hoping to make $3 on that $1 risk. So it's much easier for a stock to go up to 15% or 20% than it is for its stock to go up to 60%. It does happen. Well, we have seen plenty of stocks do that, and we've traded those on the model portfolio. Right now we have Alibaba, and that one's up 75%. But the stocks that do that and allow us to be in for that kind of a ride, excuse me, the stocks that allow us to be in for that kind of a ride, they're far and few between. They do come up, but the majority of stocks are going to go up for maybe 20%, 25%, and then they'll consolidate, and depending on how we play the stock, well, we might get shaken out at that point, or I'll lock in a gain and move on to something else. So by focusing on stocks that have an entry point and an exit point that's only 4 or 5% away from each other, it allows me to go after the 3-to-1 reward to risk stocks, or 4-to-1 or 5-to-1 if they're giving that kind of an entry. So that's what I look for when I'm setting my stop losses. So let's take a look at one of the stocks that we've had in our elite stock setups. We give away one of these for free every week to all of our newsletter subscribers, and the newsletter is free as well, so go to ChartYourTrade.com, sign up for the newsletter, and you'll get this. But let's take a look at a recent one. Okay, so here is a stock from our elite stock setups from back in July. Well, we looked at Apple, and we could see here that Apple was setting up in a flat base, and that the base itself was about 10% deep from this initial from this high over here to the low point down here. And so what we're seeing here on this chart, this black line that's curved up, that's the 50-day moving average, and this red line down here, that's the 200-day moving average. We're looking at both of these are simple moving averages. And so Apple was a leader in its space. So we all know that it was making 52-week highs, and it was not only a leader in its industry group, but it was also a stock that was leading the market higher, and that's why we were interested in this stock in the first place. And so it was setting up in this consolidation. It was doing it ahead of earnings, and it set up an advanced entry point. And when we look at advanced entry points, we're looking at a consolidation like this, where there's a consolidation within a consolidation, meaning that we're able to enter a lot closer to support. So this horizontal red line right here at the bottom of the base, that is where Apple has built support. And we notice that this level of support here, it's right around the 142 level. It tested it within the base multiple times, but that level also coincides with a former chart high or former resistance level back here. That's one of the things that I like to look for when I'm looking at support levels. Though, is it being tested multiple times? Does it coincide with a former resistance level? Because all those things make that support level more reliable. There's going to be a lot more eyeballs looking at that level because it's been tested so many times. And so the more people that are looking at it, the more reliable it is, the better it's going to be for our trades. Because if it does get knocked out, then there's a much greater probability that the stock will indeed roll over. And it will be a place that if it does break below that point, well, we'll consider it ourselves wrong and we will move on to the next trade. But anyway, So when we enter a stock, we want to try to enter as close to these kinds of major support levels as possible. And Apple was giving us that opportunity right over here, now right by this dotted trend line. And so when Apple broke above it, the advanced entry point ahead of earnings here that we listed was going to be at 151.74. So a break above that would trigger an entry for us. And we would set our stop loss not just below that 50-day moving average. I know that that's a very popular place to exit a trade. And I would do this myself many times. I'd fall into this trap of just setting it there and then getting shaken out. What we want to try to do is set a stop loss at the next level of support. So that initial stop loss wouldn't be just here at that 50-day moving average. It would be down here where support has been tested multiple times. It's very tempting to set a stop loss over here, especially if you're a day trader or you're somebody that trades just on a very, very short time frame, where if most of your trades are only going to last a week, then maybe you might want to set it there. But for our purposes, and for my purposes in my swing trading account, where most of my wins are held for a couple of months or more, I like to look at these longer term support levels. So if I'm entering here, my stop loss is going to be set down here, and I'm going to position size based off of that. So the difference between the entry point up here and the exit point down there was roughly 6.5%. Next, so that's how we identify support. So next, we want to look at the behavior around moving averages. And for that part of it, let's take a look at what Apple is doing right now. So here's a chart of what Apple's doing right now. We have both the daily chart of Apple as well as the weekly chart down here. And I am showing you the weekly chart for a couple of reasons. One, to show you the bigger picture of the move. So going back to 2014, Apple has been a leader. It hit new highs. It spent most of 2015 through the beginning of this year really consolidating, and then it finally broke out, and now it's making new 52-week highs and doing that on a routine basis. So we could see how Apple has found support on this black line here. That on this chart, the black line is the 40-week moving average on the weekly, and that red line is the 10-week moving average. And so it's more or less respected the 10-week line. When it touched that 40-week line, it did find support and bounced off that level. But when the times that it touches that longer term 40-week or the 200-day moving average, if we're looking at a daily chart, it's really far and few between. So that's one of the reasons why in most cases, we're not going to use the 200-day moving average. But if a stock does go down and touch that 200-day moving average and it reverses under the right circumstances, that could be a great place to either look for an entry point or to use it as a support level. Anyway, let's take a look at the daily chart, and let's make it a little bit bigger. So this is showing the consolidation that we were looking at on that Elite Stock Setup PDF that we sent out to our newsletter. And we entered right here when Apple broke above that entry point. And so if we had set our stop loss just below the 50-day moving average on this chart, it's the red line over here, we would have been shaken out almost immediately intraday, and Apple rallied and closed above that 50-day moving average, and that would have been extremely frustrating. You know, I've been there. I'm sure many of you out there have been there as well. And so to avoid that frustration, it's important to set our stop loss below the major support level, the levels that coincide with other areas like we spoke about. And so We're starting, so Apple consolidated, it broke out on earnings, and now it's forming another shorter term support level. And so I like to look at how stocks are behaving around moving averages in conjunction with these support levels, because again, it's putting more eyeballs on the support level. So Apple broke out and it's been consolidating sideways, and notice how this purple line, that's the 21-day exponential moving average, notice how it's caught up to the support level. Now that's going to give just a little bit more support to the support level over here and make it that much more significant if it does break down, because it would trigger exits for the people that trade based off of moving averages. It would trigger exits based off of people that are trading support levels. So when those things are working in harmony with one another, it solidifies the idea, at least in my mind. So right around here, well, what level is that? That's 154. The low is 154.63. I would say around 154.50. Well, the support. Well, when we think of support levels and stops and things of that nature, it's more of a zone versus a hard and set stop. I know that we need to enter an exact figure, but when we think of support, it's more of a zone rather than okay, it's this mark, and then once that's violated, that's it. That's one of the reasons why using these longer term levels is more important, because if let's say we set a stop right below that level, right below 154.63, well, that's a little bit above where former resistance was, right around 153.99, right? So there's now a support level between 154.63 or 154.50 and 150. So I would say that that's the zone of support, and if it starts to break below that, then you're back within this little area here, and you're looking for a test of the 50-day moving average, or even this low back here of 147.30. So that's how these things work. It's more of a zone versus an exact figure. That's where the art of trading comes in. It's not an exact science, but we look at these levels and we look at these charts to try to manage risk. And so as this trade has progressed, I would look to maybe begin moving a stop loss up, like from down here. I wouldn't allow this trade to come all the way back in, but maybe I would start moving my stop loss up to this low of 147, or that level there for part of it. Maybe I am raising another part of my stop or of my position to just below this 155 level, so that way it's not an all or nothing game. Well, we have these bracketed stops where if the stock starts to come in and shows weakness, well, we could lock in a little bit of a gain and then wait for it to consolidate a little bit more before we just exit the whole position. That allows us to protect our position and allow for additional upside while capping our downside. That's a little bit more advanced. That's called a bracketed stop. I'll have a whole video on that, but that's the idea. That's the idea. And again, just to look at the distance from entry point to exit point on a percentage basis, let's take our ruler over here. And so between our entry point and our initial exit, it was about 6.5%. But let's say we didn't use the advanced entry point and we wanted to use the standard pivot, which is generally the high of the pattern. We would be looking at a stop of roughly 10%. So within my own parameters, that would be on the extreme side that I would allow, but Apple, while it's a good stock, I wouldn't consider it a high momentum growth stock. It's definitely something that's a leader. It's making new highs. It's something that I'm interested in. It's something that I am actively trading. It's something that's in the my own portfolio, but it's not something that's I would consider one of those high octane stocks that's going to run far and fast, and it's not something that I would allow for a 10% stop loss, because it's a bigger name now, and it's harder for those bigger names to run far and fast, so it would be a lot easier for Apple stock to move up 15 or 18% and have that 3-to-1 reward to risk versus expecting a 30% move. So that's one of the reasons why I like to use the distance between the entry point and the exit point to help determine if I'm going to trade a particular stock. So that's it. That's what I have for you on setting up your initial stop losses. Again, we identify support. We look at the behavior around moving averages, and we also look at the distance from our entry point to where we are looking to set that initial stop loss. Thank you so much for watching. Please take a moment, leave a comment down below. Let me know how you set up your stop losses. Let me know if you have any questions about anything mentioned in this video. Click the like button, and also subscribe to our channel. The subscribe button is somewhere up there, so please click that as well. And also, check out our newsletter. Get one of these elite stock setups for free. We send them out every week, and they are extremely helpful. It provides not only the technical analysis, but there's also a wealth of fundamental data that comes along with these elite stock setups as well. So thanks again for watching, and I will talk to you again very soon.